All right, guys, let's get down to it and help make you some money. This is a name I've liked for a long time. Axle, American Axle, AXL. And I've been talking about this for 2 or 3 years, but I still like it. It's really coming into its own. And the chart, you can see, looks absolutely phenomenal. They don't really use the American part anymore because it really has become a global play. Now, let me give you the negatives first. Execution's been a little bit sloppy in the last 3 quarters. They missed the street 2 times. And there's been a little bit of margin pressure. But this is what I love. They are outpacing the industry. That means they are taking market share. In fact, I think over the next 5 years, they're going to take a whole lot of market share. And I think some of the costs that they're spending money on now will pay off very well for them later on down the road. The sales have been really pretty solid, 13%. Again, they got to bring the SGA costs down somewhat. I love the fact that the backlog is getting up there really nicely. Technically, you saw that chart. I think you get to 29.30, and through there, a breakout takes it maybe another 10, 20% higher. It's not a trading vehicle, but I love the way it acts, and I think it would be a pretty good fit for most 401ks. All right, Matt, what do you think of this?
I like this on 2 levels. The macro level, I love this sector. The auto sales for Europe came out today. Spain up 26%, Germany up 7%, U.S. auto sales tomorrow morning, so I like that sector. Valuation-wise, a peg below 0.5, forward PE of 9. So you're looking at a nice value play, and I think sales numbers will be good tomorrow. So you want to play this. You're not picking the actual car maker. You pick the parts maker.
Do you worry a little bit, Jim, about poor execution, the fact that they keep missing the bottom line?
Actually, I'm okay with that right now. There were 2 things that concern me, and I think the company's addressed both. One is the concentration risk with GM. But you talk about the backlogs, and 70% of their backlogs are non-GM. 2 is the company, I think, historically has been a little over-levered. But the fact is they've refinancing debt. I think the cost of those transactions hurt their earnings a little bit, their margins a little bit. But going forward, lower interest rates for them over time. So I think they've addressed the 2 concerns I have.
Non-GM business approaching 50%.
So I agree with everything you said. However, I think it's slow and stodgy and a mid to upper single-digit player long term. I don't think it's anything to get really excited. So
you want something sexy and exciting. You want something fast. You want speed. You want excitement. You want the NASDAQ.
You're in the 4th quarter of the bull market. So this is probably fine, but it's not going to really generate any excitement.
So having said that, if indeed it is the 4th quarter and the game is almost over, how much downside would this have versus one of the high-flying names? Because a lot of the high flyers who got hit today, we talk about a lot.
So I think it's an excellent point. Clearly, when we do turn and have a 25 to 40% bear market, and the downside, this will go down a whole lot less than, say, a Netflix or a Google.
Let's leave it right there, guys.